Okay, welcome back. I'm here with Clayton again. Clayton had an assignment that was to watch the video. I believe it's titled How to Beat the Market. And so he watched that. Some of you probably watched the video or similar video to that. And he had some questions about it while he was watching the video. And so he's just going to ask me those questions now, and we're going to go over them as much as we can.
All right, so as I was watching, I actually recorded an audio file, which maybe you'll be using, but just we can rehash the questions a little bit more condensed and still get that authentic question that popped in my mind right then.
Mm-hmm.
And so the very first question I had about 5 minutes in, you talk about mutual funds and some other things to kind of avoid or some common misconceptions. And I was really shocked by that. So mutual funds. Is there ever a time that it's okay to invest in mutual funds?
Mm-hmm. I believe in your question that you asked also on the audio that I heard before, you were saying that sometimes you have a job or a pension fund and the company just puts your money into some mutual fund sometimes.
I think, I work in Korea, but I think that's the case.
Yeah. So I would say in that case, if you don't have any other choice, then maybe that's just something you have to do. But then I would still, I personally would still take some of my own money and invest it in a way that I felt like I had more control. The reason why I don't suggest investing in mutual funds is because they're usually watered down and they're filled with good companies, bad companies, so-so companies. So diversifying this way is actually weakening your chances of a better return. Whereas if you can invest only in strong companies, then you have a better chance of making great returns. The other thing that's good about mutual funds is that they're passive. So you don't really have to do much with them. So that's one reason why I think a lot of people like them. And they feel like some professional has kind of crafted, this package deal for them, and this is going to produce the greatest returns. But in actuality, if you just invest in a really cheap index fund, like S&P index fund, then you'll outperform almost all of the mutual funds.
Okay.
So there are thousands of mutual funds, but I dare you to try and find one that has beaten the S&P 500 index fund consistently over the years. And if you find it, let me know, because I want to know about it. Yeah. And even Warren Buffett says that whenever he dies, he wants his money to be put into a low-cost index fund, like S&P 500 index fund. And so if that isn't enough for you, I don't know what is.
Okay. But value investing is way better than that, right? Like we can beat the S&P consistently. So
yeah, you can. The problem with value investing is that you have to be more active if you're going to be investing in individual stocks. So if you're not willing to be a little bit active and to do a little analysis and research into companies to invest in, then I would just recommend to invest in the S&P 500 index fund. And Vanguard is one of the ones with the cheapest rates.
Okay.
So
I guess maybe I hinted at this question, but how active do I need to be? Like I'm sure. Right now I'm focused a lot on increasing my knowledge of investing, and I'm lucky to have you as a guide. But like, how much time do you spend a week or a month? And it maybe varies, but how much time should I expect to put into getting that background knowledge, or running those analysis of various companies?
Mm-hmm. Okay, yeah, good question. So it depends on the market, how the market is moving. If it's a bull market, or whether it's a bear market, so in a bull market, whenever stocks are going up, I'll be buying more stocks, and I'll usually make about maybe 4 to 8 trades a month in a bull market. And then in a bear market, I make 0 trades a month, or maybe 2. So this is about my personal range. And yours will also depend on how much capital you have to invest.
Right. Okay.
So the more money that I have, then the more I split into different individual stocks.
Mm-hmm.
But when I was just starting out, say like just starting out with $5,000 for an account, then I would just invest in one company.
Okay.
And so I might only make 1 trade that whole month.
Well, all right.
And then once I got my 5% or whatever my desired return was, then I would sell it, and then I would look for another good company, and then I would buy another good company at a bargain price. So I really only analyzed that one time when I was looking at buying another stock.
Gotcha.
You can do ongoing analysis as much as you want, but I would say with value investing, you're not going to be trading that often. It's not like day trading where you're trading multiple times within one day.
And from what I understand with day trading, you're always on edge, always looking and analyzing things constantly every second, right?
Mm-hmm.
But this seems okay. It's more active than investing in a mutual fund or a S&P index. It's more active than that, but it's not ridiculously active,
No.
right? It's very manageable, it seems.
Yeah. And that's the point of this system, like that I talk about. It's trying to maximize your returns with the littlest effort possible. So you can invest all of your time and all of your effort into this, but the amount of return you're going to get isn't going to be equal to the amount of effort that you give. So,
Makes sense.
yeah. And somebody that's day trading, they might spend 10 hours a day or 8 hours a day on it, but they're doing a lot of risky things that their return might not be as good in the long run. So the patient investor is usually the one that remains successful over the years.
Waiting for the good deals?
Yeah.
Okay.
And the one that says no
Right.
more frequently than yes. The one that's very picky and is patient and waits for the perfect pitch. And when they see that perfect pitch or that perfect company at a bargain price, then they go almost all in. I mean, you still want to have some safety net,
Right.
keep some money in cash or things like that, but you want to heavily invest at that time.
I like that analogy, waiting for the perfect pitch, but also you have an infinite number of pitches ahead of you, so it's not like you just have 3 or 4 pitches coming your way.
Mm.
Is that right?
Yeah, and I think we were talking about before where Buffett said maybe you have 20 big decisions in your lifetime, so you kind of just wait for those moments and then take advantage of them when they come up.
You mentioned really quick a second ago, you're buying in the bull market and you're kind of just laying low in the bear, more or less. And did I get that right?
No, I mean, you'll end up, or personally, I end up selling more frequently in the bull market because it keeps going up quickly.
And so you're taking that profit and then looking for another place to invest and then take profit from there, hopefully, and keep ratcheting up.
Mm.
Whereas in a bear, it's less activity because things are just going down and
Yeah.
you're waiting for a
I
better
mean,
buy.
in a bear market, it can be a great time to buy
Okay.
because stocks are really low. So
Okay.
I might buy a lot of stocks if I have the money available. I
Mhm.
might buy a lot of stocks at that time,
Mm-hmm.
but then I'm just sitting on it and waiting until the bear market or the bull market happens until things go back up.
Because in the bear, the market can just kind of be stagnant, is that right? And you're just waiting for it, which it will eventually rise.
Yeah, I'm waiting for my stocks to go up, and so that they'll sell at my desired sales price.
Okay. So at that time, you're really hardly active at all. I mean, you're still analyzing at times, but it's during the times that you're selling and hopefully taking that profit and finding another opportunity. That's when you're really active.
Yeah,
Okay.
but it's still not that active.
Yeah, relatively. Yeah. Okay.
Yeah. So
Good.
so you don't have to feel like you have to become a full-time investor.
Yeah, I can't do that.
You could still have your full-time job and just do this on the side.
And it seems like you flashed a very astonishing couple figures in your video. You said the S&P gains over X number of years versus value investing gains and Buffett's gains over those number of years. I mean, it seems like the amount of time between S&P totally passive investing and value investing, maybe it's a gap like that, but the gains are like that. So even though you're investing a little bit more time, it seems well worth it based on the facts that you're telling me.
Yeah, because you have the advantage of selecting a company that is it's at a really great price, and you can buy these individual companies and you can end up putting a lot of money into a really good deal. And so you have the potential to make a lot more that way. Whereas the S&P 500, if you just invest in the S&P 500, typically they're good companies, big companies, but you still have some kind of so-so companies in the S&P 500 as well.
Yeah.
So it'll be more watered down as well than if you're buying individual companies.
At the right price.
Yeah.
Okay, so kind of my next big question was around the 950 mark. You displayed a list of all the companies, of all the criteria. So starting around the 950 mark, you displayed a list of all the criteria that Buffett kind of looks at. It's a list of a handful of things. And I just want some context of how many is this an exhaustive list, or are there many more criteria and variables that he looks at? Has the list changed over time? I'm a newbie, so I'm just trying to get my bearings on.
All of the above.
Is that right?
It's not an exhaustive list. He looks at other factors as well.
Okay.
Those that I stated in the video are some of his favorite
Gotcha.
things to look for. And you have to keep in mind that if you try and focus on all of this information and all of these measurements or criteria, it's going to be overload, and you're not going to be able to process it all anyways. You need some kind of software to help compare the companies. But if you can find a few that are the most effective at telling the story of whether you have a good company or not, those are the ones that you should stick with. Remember, we're talking about maximum results from minimal effort. So if you can find the smallest amount of criteria to find a good company, then stick with those.
So those are the ones that he found, and those are the ones that you use.
Yeah, and then at the same time, even though we might say that these ones are the most important, let's say, if you take one, for example, like return on equity, and if you only look at that criteria, but you don't look at the other ones, sometimes this doesn't give you an accurate picture, this one measurement. So you still want to get a few so that you kind of get an overall picture of the stock or the company. Because not just one is not going to give you an accurate picture.
Okay, yeah, that makes sense. And have those, those handful, like 5 or 6 that you display, have those shifted over time, or the importance of them? Is there 1 or 2 that are always more important, or I assume that does it shift over a couple of years and focus on when it's shifted, or every situation is different?
I don't really know because I haven't been investing for decades.
Okay.
But I can tell you that Benjamin Graham and Buffett, when they started their careers, they were looking at the same kinds of measurements. So I would assume things don't change that much in that department.
Okay, yeah, that's exactly the context I needed.
So
We're on the 13-minute mark. Grant, you talked about manually, when you first started investing, you were kind of manually going through websites and finding information and manually analyzing various stocks. You said it took like at least 30 minutes per company that you were trying to profile to build that up. I'm curious, like, how were you building that up? What was it that you were doing that was taking these 30 minutes?
Okay. So far, one of your assignments was to listen to the Warren Buffett way,
right,
or to read that book, and you did that. And that kind of just gives you a background of kind of value investing in the way that Warren Buffett invests, okay? Then the next thing I wanted to recommend to you, which I mentioned, was the Buffettology series. So when I first started out, I listened and read the Warren Buffett way, and then I moved on to the Buffettology series. And in the Buffettology series, this gets a little more into the criteria that is the basis of how I started investing and analyzing stocks. So it kind of tells you what Buffett's most important criteria are.
Mm-hmm.
And then what I did was I just set up this very basic spreadsheet, and it had the various columns, for gross profit margin and return on equity and ROIC and each of these. And then I would have to find the stock, let's say Coca-Cola, which is KO,
mm-hmm.
and I would just go online and type KO return on equity. And then I would have these websites that came up, like Yahoo Finance or ADVFN, and I would just try to piece all this information, and kind of paste it into my spreadsheet, my manual spreadsheet. And the problem with that was that whenever you're looking at value investing and using like Benjamin Graham's Intrinsic Value formula, you need long-term, like 5 to 10 years of information. But a lot of these websites, they only provide up to 5 years, maybe is the most. So I kept running into this problem where I was pooling this information, then I can only get maybe 5 years the most. And it's difficult to find at times. And then one website doesn't have all the information that you need, so I couldn't fill out all the columns.
Even from one website?
Yeah.
So
then I had to jump around, and then I was pasting the link, go to Y charts to get the ROE, go to this one to get gross profit margin. And yeah, easily it took a half hour just to get this for each one, and then I have to average the 5 years and, for each criteria. And then let's say that you do find all the information for one company, and you take whatever, half hour or an hour to analyze it. And then you find out, it's not that good of a company.
Right.
There's an hour, and now you have to do the next company, So manually doing this, you're not going to be able to find that many good companies. And then you also have the problem of trying to compare them against each other, right? So it could take you a month of manual analyzing just to find like a handful of good stocks to buy. And then at that time, you've already wasted a month, so things might have changed.
Okay.
And prices have changed and things like that,
That dovetails into another question I had, which was like, how often does it change? So how often would one have to analyze a stock? And it could be changing by the minute. Is that possible? Or I know with value investing, you're looking more long term.
Yeah. Well, the price obviously changes by the second, or less. But with the actual company, the fundamentals and the strength of the company, that's not going to change that quickly,
Mm-hmm.
Because you might have a good company that has been a good company for decades.
Mm-hmm.
So it's pretty much going to stay at a similar, company rating, we'll just say. The strength of the company will maintain itself pretty well. But there are times when companies have a slump for a few years,
Mm-hmm.
and they just have terrible earnings reports for a year or a few years in a row. And this could cause the company to not be a good company to invest in at that time.
Okay.
So those things could change. The price will change very quickly,
Right.
but the fundamentals and the strength of the company, it'll stay more consistent.
And then, so you were manually going through and taking 30 minutes each time.
At least, yeah.
Okay. And then what's the alternative to that? So you were doing that, and what are you doing now?
Well, then I just started trying to figure out ways to automate this. So I was just trying to say to myself, how could I pull this information from Y-chart and from Yahoo charts or Yahoo Finance without me doing it manually. Then I learned about Excel macros, and then I just started kind of teaching myself macros because you can use that to pull information from online. So this would eliminate me manually pulling information from each site that I visited. And then I went a step further. Once it pulled all this information in, then I wanted to automatically compare one company against the other and then put the better company on top. And then compare against the next one and put it on top. So compare all these stocks I analyzed, put the best companies on top.
Wow.
And then the end result was kind of I made my own stock analyzer. And then I was just doing this for myself. And I started backtesting it. I backtested it for 10 years. At this point, I still didn't know if this was effective, if it worked, So I backtested it for every month for 10 years. And the results were that Buffett was right. His methods worked. And it was beating the S&P 500 like 85% and more of the time.
Wow.
So I was just like, it works, And some of my friends that invest in stocks, I started telling them about it, and then they were interested in checking it out and stuff, and then they were saying to me, you should try and sell this, or you should try to promote this to other people or whatever, make it an actual analyzer, and then one thing just led to another, and then now I offer it to other people as well.
I gotta say, at first, I glanced at the analyzer. I'm still, learning from you. But when I saw analyzer, I was thinking it just does some analysis. But from the past, few days talking to you, a few meetings, and just right now, I'm gathering that not only does it analyze the stocks and kind of compare them, but you've very thoughtfully and strategically decided what variables should be included in there based on value investing.
Mm-hmm.
But also, if nothing else, this is just a huge time saver that 30 minutes per stock at S&P 500 and NASDAQ or all these huge lists of companies would take months and months. It's just not feasible. So this it's kind of like a trifecta, or maybe more than that. Maybe there's more points where this just really simplifies and enables, hopefully, me to invest.
It saves a ton of time. And there are a lot of stock analyzers and stock screeners out there that can do something similar.
Okay.
The thing is that you don't want to get caught up into thinking that this is the only way to invest and this is the best way to invest by just letting this software pick your stock and you just blindly invest in this.
You're talking about yours and other people's?
Yeah,
Okay.
any software, the human brain is way more powerful than even the most powerful computer. Okay?
Might be some exceptions.
Well, anyways, there are other factors that come into play. And we had talked about these before. So there's quantitative analysis and there's qualitative analysis.
Right.
So this might do a lot of the quantitative work, but the software, any software, still cannot predict what's going to happen with a company in the future, or how well the management is run, and whether you are comfortable in investing in a specific company, and how much your knowledge is of this company, and things like that. So you also have to just take this analyzed information, and it'll give you maybe a handful of 5 stocks to invest in, let's say, like recommended or possible buys. Then this just eliminates all these other stocks, so you don't have to waste your time on them. Just focus on the 5. Then you want to do your own further analysis on these stocks and figure out which one of these 5 you want to invest in, if any.
Yeah, the qualitative factor.
Yeah.
Like, I'm sure around the time of the oil spill, British Petroleum stock probably tanked, and like someone living on the Gulf Coast would not want to invest in that, based on their conscience or some personal reasons.
Yeah.
So that would be a qualitative thing.
Yeah.
Good. All right. So you've really well explained how you analyze manually and how you do it now, and I'm definitely sold. I know your analyzer.
Yeah, but mine's not the only one, and there are others out there. Just this is one that kind of works because it compares all of the stocks against each other too. A lot of the analyzers out there, you can just analyze one stock at a time. It still saves you a lot of time, but you can't compare them all against each other.
Yeah, I mean that's when you have thousands and thousands of stocks. I think you definitely want to be able to compare them, though.
Yeah.
So,
Mm-hmm.
okay, well that's good to know that there's others out there, and but yeah, yours focuses on value investing, which others might not have that focus.
Yeah.
Is that right?
Yeah.
Okay.
Yes.
So this question is about intrinsic value, which you just mentioned at about the 15-minute mark. So with intrinsic value, I'm wondering how often that value might shift. Like maybe a company will have a higher intrinsic value today than tomorrow, or if that's something that shifts over a longer period of time.
Mm-hmm.
I mean, it could be different for every company or every situation, but generally speaking,
Okay.
how often?
So whenever I use the analyzer, I might find that the same 4 or 5 companies are always at the top for about a month. And then maybe something shifts, and then some new companies replace a few of those. So I would say that the intrinsic value doesn't change that frequently. It goes up and down a little bit, but it doesn't change like the price changes. Okay. Some reasons why the intrinsic value would change is after earnings reports. So the intrinsic value is based on the earnings of the company, and each quarter the companies report their earnings. And if the earnings are low, or say lower from the previous quarter, then this could affect the intrinsic value. Because with the intrinsic value, you want to see that the earnings are increasing and increasing consistently over the long term. So if they have a really poor earnings report, then this could affect the intrinsic value.
Okay.
So you could look for maybe a big change could occur over 3 months or something like that.
And you said like each quarter there are reports. I don't know. Do reports come out on the same day for most companies, or
No, it's within maybe like a month. Each company has their own reporting date.
You've mentioned that drives another question. You mentioned kind of quantitative, insight versus qualitative. Is there ever a time? Could there be some instance where you're very familiar with the company and their earnings report is off, but you have some reason for that you know of, like I don't know, some bird flu or some MERS virus in Korea or China or something like that just made demand crash. Has that happened to you where you're aware?
Definitely.
Can you talk about that?
Yeah.
What do you do?
So there are affecting factors with each company, and that's why it's really important that you understand the company that you're going to invest in, because you know what these affecting factors are.
Mm-hmm.
So, for example, a company that makes a lot of money by exporting their product overseas, they can really be affected by the strength of the dollar. So they could have terrible earnings over 1 year because of the strength of the dollar, So in that case, it's not really a problem with the business itself. It's just some kind of outside affecting factor that caused the problem with the earnings. So if you still know that this is a good company and it's at a bargain price and you know about the company, you understand it, then you still might want to invest in this company.
Great. Yeah, that answers my question.
Okay.
I think that's it.
Okay, so Clayton's questions for me are finished about the how do I beat the market or how to beat the market video. So I have a new assignment, and this one is now the Buffettology series. This is by Mary Buffett, and you can check that one out. It's on audiobook or you can buy the book. And like I said, this one goes into more detail about how Buffett analyzes companies, what he looks for. Okay. The other thing we still wanted to do was try and analyze a company in a simple way, just by using Yahoo charts or Google Finance chart. Then you're going to see the company's progress over 2 years, 5 years, things like that, and what price you should buy that. So we'll do that later. And that's about it for today. We're going to wrap up. So thanks for joining. Thanks for your questions.
Yeah, my pleasure. Thank you, Grant.
You've been a great student.
Doing my homework.
And I enjoy working with you.
Yeah, me too, man.
Okay.
Yeah, thanks.